We remain in what I call sort of a twilight zone between, a very robust mid-cycle and sort of something closer to late cycle. We're not there, but late cycle is typically when growth starts to slow, and of course inflation is rising, the Fed's tightening, but the economy remains very robust, especially in the U.S. And we have these cross currents. We have an earnings boom. Earnings season is now underway. It's looking like 21% earnings growth. And that's a very powerful tailwind that forgives a lot of other sins in the market. We have liquidity tightening from the Fed. We have now trade tensions, which generally should be seen as stagflationary because it's going to eat into profit margins and maybe raise prices. So there's all these cross currents. And in the meantime, for the last 6 months, the S&P has been absolutely stuck in a range.
All right. Larry Fink of BlackRock, numbers out today, said that lack of breadth in equity markets is troubling, with a few tech-related names accounting for most of the gains since what came out of the conference call today. That's true,
yes.
Right? Empirically true. Is it troubling, though?
Ultimately, it will be troubling if it persists and we don't have a rotation into other sectors. I mean, typically when you get into a very late phase or a very mature phase of a bull market, the leadership gets pretty narrow. But while the S&P is being helped only by a couple of really big names, the Russell 2000 is making new all-time highs. Those are small caps. So there is some breadth. It's just that the leadership is very selective, and only the really big growers are getting rewarded. And on the financials, I think they got sold down prematurely because of fears over the yield curve. I think that whole argument is probably going to be premature, so I'm not surprised that the financials actually doing better here in the last week.
Because the curve will steepen again, or
not that it will steepen, but historically when the curve has inverted, other things have been in place that are likely not going to be in place for a while, and that the main thing that's usually also in place is that the Fed by then has raised rates well above the so-called natural rate, or R star. And we're still under it. And even if the Fed were to tighten 4 more times and invert the curve, and I'm talking about the 3-month to 10-year, the Fed would barely be in restrictive territory. And I never want to say it's different this time, but that will be a component that will be probably missing for a while. And that's why I think perhaps the financials have been punished too early.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.